Welcome to Which Stock to Trade Now. Helen, been a while. Good to see you here. And hopefully you can hear my voice and see the screen being shared that I've got up here right now. I'm looking at the various sectors. If for some reason you can't see the sector screen, chat in, let me know, because I want to get that straight before I go on. And what I got here is a look at what's been happening on a, sector by sector basis here over the past 3 months. And it's always a good idea to keep an eye on that portion of the US stock market because, this kind of tells you how investors are choosing to split up their money. And Helen, you're referring to the tornadoes out there. That is awful. And it actually has some real disruptive impact on shipments terrible impact on those who were injured or lost their lives or lost their property, but economically speaking, it also has an impact on people that are expecting shipments to come out of that portion of the country and are not getting them. So that'll actually play into an item or two that we look at today. Well, the markets have opened and they have opened positively. We'll get to that in a second, but the sector movement looks like this. The S&P 500 has, it looks like it's declined a little bit just at the open, has been right up at its old highs. And what sectors have kind of been leading the way? Well, the stuff that's on top, that's what has been strong over the past 3 months. But as you can see, the energy sector, which is at the top, really hasn't been doing a lot since late October. It's more trending lower. And consumer discretionary is the second one, but it kind of peaked out the middle of November and through the Black Friday area, we really, saw stocks sell off hard. They've rebounded, but they sold off. And so consumer discretionary, the XLY, that's stuff like Home Depot, Comcast, Disney. It's things that people spend their money on that they want to spend their money on, not things that they have to spend their money on, like consumer staples, which is this yellow sector down here. Look at how the consumer staples sector has been behind, but now has kind of caught up. And just here in the past few days that's what's leading the markets higher. That's kind of weird because as a defensive sector, this is stuff like Walmart, McDonald's, Costco. Amazon is actually, they usually get classified more in technology or something, but in terms of what the company does, Amazon's this mix of, because it sells everything, right? It sells consumer staples and consumer discretionary. So I always like to go at times like this. I always like to go and compare Amazon to the other stocks, and I'll do that in just a second. But the big thing is that we've got technology roaring higher, thanks mostly to Apple, and consumer staples, which is also pushing higher. So between the two, the market is trying to sort of telegraph people that it's looking for sure bets. And those sure bets are what they think are the consumer staples and Apple. So that's a little bit of an interesting thing. S&P is just down, looks like not quite 0.2%. So it's off just a very little bit. But the activity that's okay, all good. The activity that is catching people's attention is really the defensive stocks. So I want to kind of focus on that. Last week, I put in 3 paper trades, and let's quickly review Actually, I didn't put this one in. I let it roll because was still out there. Express spa stores. We'll look at that in a second, but I mean, it keeps doing better, and that's important all by itself. Krispy Kreme donut hasn't stopped out, but it hasn't gone good. And then Lowe's did improve, up and down, but it's net improved as of now. And that's Lowe's is part of the XLY sector, so that's really kind of interesting. But for this week, what's stock to trade now? Well, see, I think Costco is actually a really good play because of that defensive sector being up. Now, Costco is kind of an expensive stock. However, if you have the ability to buy fractional shares if you have a small account, or if you just buy a smaller number of shares if you have a large account, it's still a good play, I think, because it's inflation. It's, sort of a hedge against inflation. There are not a lot of good hedges against inflation right now. In fact, if I look at this chart and just do a quick run through, what's the typical stuff you think of when you think of hedging against a declining US dollar? And that's what inflation is. So you think of gold, right? No, gold doesn't look like a very good inflation hedge lately. I mean, it's going down. And part of this is because, the dollar, the US dollar index has actually been going up, right? But the prices of things in dollars has been going up even more. So even though we see the US dollar going up, which the dollar index is the dollar compared to itself and a little bit compared to the euro, which is why, you see it going up even when dollar denominated goods are going up as well. So when you see inflation going up and the dollar going up, we're noticing that the inflation is going more than the dollar. That's the thing. And quick look at Amazon. See, Amazon's going down. Why is Amazon not an inflation? Because everything in Amazon is priced in US dollars, right? There's some complicated reasons for that. I'm not certain how irresponsible or otherwise it would be for me to speculate on what those problems are, but I feel like the very thing that makes Amazon such a worldwide strength is kind of weighing on it right now. But also, there is the situation with the tornadoes in the Midwest. There's a lot of stuff that just can't get shipped out. And so that might have some impact on Amazon's, Christmas revenues. Maybe. I would think that would be small by comparison to everything else that's got going on, but it might be influential enough that that it's helping others. So anyway, Amazon going down and Walmart going up and Costco going up, right? Now, here's why I like Costco, because if you've been following me, I really like the gap trade. And that's what we've got here. We've got gap up to a new high. And it was one of these, it comes down, closes here, opens here, runs all the way up to there and closes up there on the gap day. Tall range days, clear gaps, window in price between the old high and the new low. It goes from below and crosses up above the 10-day moving average. Those three things together, the gap, the crossing the 10 and closing high on a tall range, all those three together. Oh, Stuart, you don't see the charts. Okay, I thought that I was sharing my screen. I apologize. Not sure how that. Okay, here we go. Sorry about that. Thanks for chatting in, Stuart. Appreciate it. So here's what we're looking at. Hopefully you can see the chart now. Okay, let me run through that really quick. Costco gaps up and it crosses the 10-day moving average and closes higher. And from the gap up there, the range is larger than 1.5 times the average true range. I mean, just in average, you look back at these candles, and if that whole move is bigger than the average by half, that's what I'm looking for. Yeah, Helen says, guess the festive season works for Walmart and Costco and grocery stores, but not Amazon. Books, gadgets, perhaps. Yeah, I don't know. But I mean, Amazon's everything. People buy diapers off of Amazon. So it's not like you have some sort of a preference for goods that that matters materially to the bottom line. I don't think. I think that Amazon's problems are bigger than just a shift of, you know, yeah, peeps just got tired of Bezos getting so rich. That's a thing. That is actually a thing, weirdly. And I don't know. I mean, Bezos owns so much of the media outlets or has influence on them and buys so much advertising. Nobody ever dares write anything negative about Jeff Bezos or about Amazon, unless it's to say they're not paying their workers enough. You know? So that whole thing, I don't know. What about degradable food? Yeah, you're right. Nobody's buying perishable foods on Amazon. Well, at least not very much. But don't forget, Amazon owns Whole Foods. So if people are coming in and buying food, you know, fun, fancy food for the holidays, they're definitely shopping at Whole Foods in those parts of the U.S. where Whole Foods is. And am I still on here? It says oops. Oh yeah. So yeah, I think that the problems are bigger than just, you know, the kinds of stuff that's going through, because it's a holiday season. That should be a great time for Amazon, and instead we're seeing Costco and Walmart head higher, and I think that has to do with investors' preferences more than it has to do with earnings potential. And so Costco here is playing out perfectly, because what we like is a gap that goes, you know, like this, and then somewhere in the next 5 days, that's this week, you can pick this up at a price lower than the close. 58% of the time, these kinds of gaps, so not quite 2 out of 3, about 2 out of 5 or 3 out of 5 chances, you will be able to buy this lower than this level over the next 5 days. And then you have a 65% chance of outperforming the market, outperforming the S&P 500. Where do those percentages come from? They're an extrapolation I put together from a study, and the study is one that was published in the Journal of Technical Analysis on gaps, and it's in the 2013 Journal of Technical Analysis. But in any event, it says that gaps of a certain kind do better, and this is your best comments on Bezos. Oh, we cut out during the Bezos thing, huh? Oh, okay. Well, I was just saying that Bezos owns so much of the media. He owns the Washington Post. He and Amazon buy advertising from so many other media outlets that most people won't write or say anything seriously negative towards Jeff Bezos or Amazon, except if they feel they want to say, you know, rag on the Amazon's working conditions aren't very good. And most of that stuff comes from, you know, people in the media who have friends who work at Amazon who complain and stuff. I don't feel like the national attitude gives a lot of credence to those ideas. But whatever. So here's Costco right here, and while I'm blabbing, it's inching up. So I'm going to go ahead and jump in on a paper trade for demonstration purposes here only. I'm not a licensed financial advisor. This is not a recommendation that you should actually put Costco in your personal account, trading account. So we're going to go 555, I'm going to come all the way down to here, 523. So that's like 55, 25, $30 stop loss, $32 stop loss, and a $16 take profit. That's my setup. Risk 2 to make 1, win more than 70% of the time if possible. That's my goal as an investor. It's the way I do it. For those of you who take my classes, that's the Malamute or the Pack Dog or the whatever you want to. Wolf is another, but that style of hunter. And so I got a limit order at 77. Where is the? Oh, that's where the trade 77. And okay, fine, let's hit it. Okay, so I put on a position of Costco. Added that to the positions here. We'll see how that shakes out next week, because not only is it a strong sector, but it also has the gap signal. So I like that setup. Let's go back and look at Express Spa real quick here. And this is coming down, still holding on to the position because I think it could have more to go. Should move the stop up to 163 though. Let me do that. Protect position. Well, I want to modify, but yeah. So originally I had the stop at 167 and I bought it at 154 or 127. I bought it at 154. So now by modifying it and moving it up like this, I'm locking in at least some degree of profit, assuming of course no gap down, which is not an infallible assumption, but it is true most of the time. Most of the time you will get filled on stop loss orders. And the times you don't, there will be occasional big losses, but if you're trading well, you make up for that. So let's see, Express Spa, I have now increased the stop loss to around or to right there. You see why I did that is that when we go up and break a new high, which is what we did here, then we go to the most recent low, and that's where we put the stop. It might take a long time before a new high gets launched, but when it does, then I'll come to whatever low. That might be here or it might be lower. But that's how, that is the most effective way that I have found. It doesn't always work perfectly. But I usually do that in addition to also trying to pick a point where I say, okay, that's it. It's not going any higher. And if I were to add the Keltner channels on this chart, and specifically to put the Keltner channels into this style where I say, give me the 5-day 4 multiplier on a 20 ATR length. Oh, wait, no, not 5, 10. Let's say that's way up there. It shouldn't be that high. There we go. That's a little better. And no, I don't want to use the exponential moving average. Okay. Here. So if for some reason price really gets going and it runs up and hits this level, then I'm just going to take it. That's assuming I'm already in the trade. And now there are times where it's already running up and it's hitting it to begin with, in which case then you sort of look at it a little differently. There's another way to do this too, also to try to figure out where is a good point at which to take profits. I'm going to draw that line just so I can move it around a little bit. Well, actually, I'm going to draw 2 lines. I'm going to put one in here. I'm going to put this one at the entry. The entry on XSPA was what, 154? Yeah, 154. So let's move that down to where we got in this trade. So now this works regardless whether you're trading a penny stock or what, but so 154. Yeah. And let's look at the days here. So today is 13th, 7th. 6, wait, 13, 10, yeah. There we go. 3rd of December is a Friday, 6th is the Monday, 3rd, going back from the 3rd was the 26th of November. And then that Monday would be the day that we got in right there, 22nd. So on this day right here will be where we entered. I'm going to go ahead. Well, I'm going to leave the blue line there. Anyway, you get the idea. That's where the entry is. So if I go 4 ATR from there, all right, the 4 ATR from there is that line, you know, from wherever I got in, right? So I could establish that as my first potential exit, profit exit. If you go up 4 ATR and you kind of go up really quick, that's actually a pretty good place to take profit. Notice how 4 ATR on XSPA, as soon as it hit that, it sort of paused. I felt after it did that and it didn't come down, and the volume, I should put the volume on here. The volume was strong. Why is that not showing? Oh, there we go. All right, see how the volume has increased its amount and stayed, right? When you have a substantial increase of volume and it stays, that, you know, this big spike from earnings, but then even after it hangs around, people are here, staying here. Then it starts going up, and see how that volume is continuing? That usually means there's another run on the way. So that's why I haven't gotten out of this trade just yet. Otherwise, I would have absolutely wanted to take the profit right there. Now, since I stayed in it, where's the next place to consider getting out? So let's see if I, from that one straight up to there, that's got to be that. And let me, there we go. All right, so the next one is 8 ATR, and I can pretty much just go 158, 182, and then the difference 78, 24 cents, and keep going 24 cents higher. That's going to be $2.06 right there. That's the next profit target. Consider, if you get to that point, consider getting out. So it's like 4 ATR from wherever, you know, that amount in increments from wherever you get in. It's a weird little trick which I learned from a guy who's a commodity trading advisor, and he noticed it over the years and did studies on it, and said he couldn't explain why it was, but 4 ATR from your purchase price and then multiples of that amount tend to be good places to exit. And I've hypothesized that, you know, it's probably the case that you and other people that got into the trade at the same time you did, 4 ATR is like enough to be, oh, it's up that far. Gosh, I wonder if I should take profits. You know, if people have that reaction, it's no big deal of one person, but if a lot of people all have that sort of similar reaction, then price starts to change. So I don't know if that's it. I have no way of proving that, but I've always kept this on my radar as a mechanism for sort of hitting the profits. Like, you know, if it goes up and then it dips and you're raising your stop and you keep doing that, eventually it's going to go up to some level and come back down and take you out at your stop, right? What you really want to do is somehow have this magic way of when it runs up to this huge peak right before it comes back and takes your stop out, that you got out up there, right? So this is how I attempt to do that. I watch these 4 ATR moves, and then if in fact it just runs up and seems to come back to it, then I consider just going ahead and taking the profit right there. I've done that enough times that it has yielded amazing results. I get up there and I get this incredible trade, and I'm able to say to myself later, yeah, I got in here and I got out there. And it looks like a genius trade, but I mean, not all of them go that way. Anyway, it just is, it looks too good to be true sometimes, but better to have them happen sometimes than never happen at all, right? Okay, so that's actually something that holds true regardless of what price you're looking at whatever kind of setup you see. So as an example here, we got into Costco somewhere there, right? What was our fill price? 77, 54.77. So, oh wow, we did all right. Yeah, so somewhere close to there. That's our entry on Costco. And then what I'm interested in is 4 ATR higher from where we got in. Well, so that's the average price at the time. So 1, 2, 3, 4 ATR plus looks like in about 1.5. So it's going to be somewhere like right up in there. That's our profit target. Just we're watching that. That's 4 ATR from where we got in. And that isn't my actual profit target. If you'll recall, my setup was that I put the stop loss down here, and I'm risking 2 to make 1. So my trade setup was actually something like that. And let's go see, where is my profit target? 570. Yeah, it's essentially right there. Okay, so if in fact Costco runs up in the next day or two and gets that, I'm happy with it. I'm out. If on the other hand it goes down and then comes up strongly and stops really close to that line but doesn't, actually take it out, then I want to go remove that stop loss, remove that profit target, raise the stop loss up to break even, and then let it run. If I let it run, then this is the price up here that I'm going to watch to try to take profit. Okay, so anyway, that was a lengthy explanation for that whole how do you raise and maintain and move your stop along, which, I mean, that to me is actually a bigger money maker than picking the right stock. So I hope you don't mind me having taken most of the 30 minutes that we have together to cover that, because if you find a good stock, that's how you really end up raking in most of your money. As for the other stock that I mentioned, Apple, it's way up. Right now is not the best time to be a buyer, but it is still going to be a good trade. It's on its way to 200, I believe. And so it's worth keeping an eye on. Low is up, but sort of coming back a little bit. I think this is a interesting stock. Let's see, 1, 2, 3, has not yet hit the 3 band. And remember, the first time it hits the 3 band after a while, it's the chances of it being higher a month later are better than average, better than random. So it's that one's worth keeping an eye on. Home Depot is the same kind of situation, although Home Depot's flattened out. So this is actually going to be good somewhere between now and the end of the year. Then that's going to take off again. Speaking of the end of the year, this is the last presentation that I'll be making for 2021. We will resume again in January, about the third Monday of January. I'm looking forward to that. And it should be a good time to be trading, though. So I want to take just maybe an extra minute or two and give you some ideas of what to watch for. Now, everything I just said: Home Depot, Lowe's, Apple, Costco, Walmart, all of those are ones to watch. But how would we find stocks that are penny stock opportunities? And see, I do feel like we're going to see some good penny stock opportunities through or small cap opportunities. See, small caps are down and penny stocks are down. So like right now, they're getting beat down. Don't be buying them just yet. But I believe that before the end of the year, markets are going to start going up. And so what you want to watch is IWC and see if, in fact, for example, does this hold and does it start taking off, right? If it does, then there'll be some fantastic penny stock opportunities. What might they be? Well, let me just go to FinViz and run my little penny stock screen. and basic penny stock screen. We got 98 choices here, and I'm going to whittle these down to the best few. Let's see. I'm going to go with short, float short, over 20. Are there any of those? There are 3 of those. Yeah, okay. And do these have strong volumes? That one does not. Bummer, because that's the one I like the best in terms of the chart look, but the volume is so tiny. Still, this is one we should keep on the watch list, IVC. I'll do that in a second. This one has the best volume, but it has probably already run its, let's look at that though. Ownership, the float, oh my, is only 6 million shares and is trading at a volume of 19. It's burning through burning through its float 3 times. Market cap's only 37 million. Float short is 32. Whew. Yeah, I think we better spend a little time on this. And then the next one is RMO. Oh, so that's not the average volume. That's the current volume. Let's look at all 3 of those stocks, come to think of it. So we're going to go IVC. Yeah. So no, that I got it wrong. It says IVC, Innovair Corporation, and it's 272, but this IVC is a different one. So I gotta go make sure I'm getting, there it is, Innovair Corporation. All right, this one. Let's bring up the volume on it. Yeah, okay. So what we're going to look for, don't touch this just yet. It's come down too far. It's hit the 4 band. We like stuff that hits the 3 band and bounces back up. If it comes down and hits the 3 band and turns around, that could be a good signal. If it goes up and makes a new high and starts trending higher, that could be a good signal. We're also looking for stronger volume coming in. So I don't feel like this is a good entry just yet, but it could be. And this thing is really going to move if in fact it's going to turn around. But here's the interesting thing about it. You see, it only has a float of 33 million shares, and its float is short is 26%. So more than 1 in 4 traders in the stock right now is short. If all of a sudden it starts to turn around, those people are going to try to hurry and get out. And it's going to take 7 days for them to get out, which means the short squeeze on this thing is going to be strong. And so if in fact this thing moves up, it could move up very fast. So IVC is worth watching. And the next one here, PTPI. Now this one's a lot weirder. Petros Pharmaceuticals, NASDAQ listed. Yeah, see how tiny the volume is? But now it's had these big spikes in volume, and this volume is hanging around. That pullback with higher volume hanging around, and it implies that there's still more to go. We haven't jumped up quite as strongly, but you look at the amount of, let's check out these trades here. Let's see what the amount of volume on this is. 51 million shares and 24 million shares. If I come back here and I look at the float is only, it's already trading 19 million this morning, so 20 million. So the float is 32% of the short is down to 0.17. See that short ratio? Yeah. So this one, the squeeze has already played out. But that's kind of the point, or that's worth pointing out here. Look at this. You see how it goes shooting up like this, and then it shoots up here, and it shoots up there. This is people who are short trying to hurry and get out. And when they try to get out, because it's such a thinly traded stock, it's hard for them to do so. And look at how much the price moves. We go from $2.35 up to almost $4. I mean, not quite double in just 2 days, right? That's what a short squeeze can do. Can do it that fast. But this one is, I think, is already played out because that short ratio is down to 0.17. RMO, on the other hand, the short ratio is still at 6.32. So let's have a look at that one. Yeah, see how this huge volume through here, but now it's come back down. This is people getting short right here. They're not panicked. They're not getting out. They think they can hang around and stay short in here. So this is probably one worth considering watching. Make sure this is actually the stock. Romeo Power Auto Parts. Oh yeah, Auto Parts. So this is pretty good. See, this thing could have a short that would take it all the way up into the $5 range. From $4 to $5 is not the most amazing thing for a penny stock, but it's not terrible either. So that one's worth keeping on a watch list, maybe even initiating a trade right away, as is IVC. So those are two to add to a watch list for sort of real quick hits. And you could reduce this to, over 10% and get a larger number to be looking for and find some other possibilities. But I wanted to show you how to go looking for those, because short squeezes are still a thing. Yeah, all right. Well, I think that through the next year, or through the first month of the year, January, the January effect is that small caps tend to outperform large caps. Small caps have been beaten down so heavily. I mean, they're obviously not running up right now because you've got, the defensive stocks, and people want sure bets. So they're not looking at the Russell 2000 or small cap or micro cap. They're not looking at any of that right now. But if they get settling in and feeling like, oh, okay, well, the market's not under threat, inflation isn't going to take away our chance to make gains. The U.S. debt ceiling will get raised, or is going to stay available. The U.S. government isn't going to go kaput. People start really just feeling fine about the markets. Those small caps are going to light up. And I think that will happen in January, assuming the market wants to go up at all. Now, there is one scenario that could make somehow people feel like, hey, I don't even want to be in the markets in 2022. I want out, or I want to be in bonds. I don't want to play stocks, blah, blah, blah. And that is the aging population in the United States. If, in fact, enough people in the 70-plus crowd, because they're forced to take out 3% of their retirement savings every year, they feel like, I don't even want to be in the markets at all. And so I'm going to pull all my money out and put it into real estate or something else, right? If that kind of thing happens and people just begin to sour on the whole idea of trading, oh, GameStop, I'm so done, game over for me. If that sort of attitude prevails, then we will see a very bearish January, and I think that will mean they will be that will presage an entire year that is generally trending lower. And I think the chances, Helen asking, why are they being forced to pull money out? It's actually the required minimum distribution that the IRS required. There it is. So this isn't a new law, but it has been suspended for the past couple of years because of COVID, but now it's back on. I'm going to go ahead and just give you the link there if you want to look it up yourself. But basically what it says is if you have a 401k or an IRA and you're over 72 years old, then you have to pull 3% of that money out so that it can be taxed. That law has actually been around for a while, for about 10 years, and the number was 70 and a half. But in 2019, they raised it to 22, and for COVID, they suspended it, but now it's reinstated. So that's, basically a way to force the because otherwise you could put your money in a tax deferred savings account and then never have to pull it out. If you could find some other way to live, then you could just build generational wealth. But they don't want you to do that. So yeah, we have to take out something. We didn't let you have no tax growth for nothing. Now you got to pay your taxes. So anyway, that's the law. And so if after 62 and a half, you could start pulling it out. It's true. Actually, 59 and a half, you can pull it out. So, but that's, if you want to. Whenever you pull it out, you pay taxes on it. Unless, of course, it's a Roth IRA, in which case you already paid the taxes on the way in. But the main point there is that if one or two people have to pull their money out, no big deal. If a whole chunk of some of the wealthiest individuals in America have to start pulling their money out, that's going to affect the markets. And if it does, then what we will see is the first 2 days, two trading days of January, they will be down days, big red candles. If we see something like that, then yikes, that could be a bad month for January, and that could be a bad year for investors. I don't anticipate seeing that, but just because we're not going to be doing this, I'm not going to have a chance to tell you about it until after it's already done and we're in the middle of January. Then just keep an eye out for that. So that's the one, I would say, probably 10% probability of happening, but it's more than 90%, or it's 90% the case that we'll see the markets drift up or strongly move up, depending on how people feel. And the best time to be getting into the markets is actually going to be somewhere right around Christmas, or just shortly thereafter, and holding on through the month of January. That has been a strong performer over the years, and this year I would suspect that it will be no exception. Till we come back in 2022, everyone, take care and trade well.